Okay.
This is something about a center.
Oh, good. Okay.
This is not a program.
Okay. Okay.
Yeah, okay, thanks, sir.
It's okay.
It's fine, please.
Colleagues, friends, it's my privilege to be here and welcome Professor Stiglitz to give this talk. We are lucky to have him here. Now, I request Professor Deepak Nair, who will be chairing this session, to please take on the program from here.
Well, may I just begin by requesting Mr. Arun Kumar to introduce the center, JNU, and Professor Stiglitz.
Thank you, Deepak. Well, it's my pleasant duty to introduce here. This talk is being organized under the auspices of the RBI Chair of the Center for Economic Studies and Planning. The Center for Economic Studies and Planning is one of the key centers, as most of us know, of this university. It's one of the centers where economics is taught, apart from other centers which also teach economics. Here, the RBI chair was given to the Center for Economic Studies and Planning roughly about 10 years back. Professor Anjan Mukherjee occupied the chair, and now Professor Satish Jain is occupying this chair at this stage, and we are organizing this under the auspices of the RBI chair. It's not easy to introduce Professor Stiglitz because he's already so well known. And you know, his CV, when I saw it on the website, was like a monograph, and that was only a part of the CV. So the full CV would be like a whole book. So it's a very difficult task to introduce Professor Stiglitz. He's so well known. He was born February 9th, 1943, and his current position is that of University Professor, Columbia University, and he's the co-founder and co-president of Initiative for Policy Dialogue, Columbia University. He's the chair of the Management Board and Director of Graduate Summer Programs, Brooks World Poverty Institute, University of Manchester. He's the co-chair, Columbia University Committee on Global Thought. He's a member of the CFTC SEC's Advisory Committee on Emerging Regulatory Issues. His past positions are a very large number in the CV. He started as an assistant professor of economics at MIT 1966 to 67. He was there for a year. And then he went on to various other prestigious positions. And the current positions that he's holding are Chair, International Commission on the Measurement of Economic Performance and Social Progress, appointed by President Sarkozy in 2008-9. Professor of Economics and Senior Fellow, Hoover Institution, Stanford University, 1988 to 2001. Senior Vice President and Chief Economist, World Bank, 1997 to 2000. Chairman, Council of Economic Advisors, Member of Cabinet, 1995-1997. Professor of Economics, Princeton University, 1979 to 88. Drummond Professor of Political Economy, Oxford University, 1976 to 79. And his education was he got a BA from Amherst University in 1964, and very quickly he went on to do a PhD in economics from MIT in 66-67. So you can see within 4 years he had done his BA and graduate program all together. His unearned degrees are MA Cambridge University 1970, MA Oxford 1976, and his honorary doctorates are too numerous to recount here. It'll take me half the time. We won't have a lecture. fellowships and honors and awards and recognitions: John Bates Clark Award, American Economic Association 1979, Nobel Prize in Economics 2001, lead author of the 1995 report of the Intergovernmental Panel on Climate Change, which shared the 2007 Nobel Peace Prize, so he had a contribution there as well. His international positions and boards, etc., like I'll give you just a few instances: ILO World Commission on Social Dimensions of Globalization, Chairman Commission of Experts of the President of the UN General Assembly on Reform of the International Monetary and Financial System, Board Member, Alliance for Climate Protection, Member Economic Advisory Panel of the South African Minister of Economic Development. Then he has innumerable consultancies running into several pages, but I'll only mention that he is with the Fed Reserve and OECD and so on. There are innumerable lectures, public and otherwise, that he has delivered, which I will not recount. He is associated with 18 journals as editor, associate editors, and so on. His CV lists 54 books with various editions and so on. They're also in various languages. They've been translated to various languages. But most people, not even non-economists, are familiar with his economics textbooks, and especially the book Globalization and Its Discontents, which has been widely discussed and widely translated. And his writings and papers run over hundreds of articles covering 37 pages. So, if they were to be expanded, that would be like several books altogether. But I just list the areas in which the papers are published. Economics of information, economics of uncertainty, risk and agriculture, financial markets, growth and capital theory, natural resources, theory of market structure and research and development, macroeconomics, monetary economics, international economics, development, distribution of income and wealth, welfare economics, comparative economic systems and organization theory, political economy, theory of taxation and public finance, theory of public expenditures, miscellaneous, and so on. So as you can see, miscellaneous is also there, because everything, could have been covered under that. So with that very brief introduction, I would request Professor Deepak Nair to carry the program further.
Arun, you want to meet the Vice Chancellor to give the memento now or at the end of the lecture? I'm going to follow the mandate from Professor Arun Kumar. I'd like to request the Vice Chancellor, Professor Sopori, to present Professor Stiglitz with the memento. Well, I don't intend to stand between you and Professor Stiglitz for long. Just a few words. At the outset, I'm delighted to be able to bring him to JNU. I brought him to the University of Delhi several years ago when I was away temporarily from here, but JNU has always been my institutional and intellectual home. Welcome, Joe. Arun has already provided an elaborate introduction, and I think Professor Stiglitz does not need an introduction, at least to this audience in JNU. There are only 2 or 3 things I would like to mention about Joe, which are not part of conventional introductions. First, Joe was born in Gary, Indiana. There's another very distinguished economist who was born in Gary, Indiana, Paul Samuelson. And I think Joe's association with Paul Samuelson is much greater than a common place of birth. I remember we worked together on a number of occasions in commissions on books, but I remember that Joe came to Oxford very early. He was all of 31 or 32 when he was Drummond Professor of Political Economy at All Souls College, Oxford. The other thing I want to mention is that Joe has made a film, which I saw at its opening in Lincoln Center Theater in New York. It's called Around the World with Joseph Stiglitz. It begins life in Gary, Indiana, and its deindustrialization, its decline, its sort of crumbling inner city. And it is a film about globalization and its discontents or its consequences. And there is something that might touch a chord with this audience, that Lakshmi Mittal bought the steel plant in Gary, Indiana, in an attempt to revive it, not long before he bought Arcelor in Europe. Now, with these words, I want to invite Joe to speak about the global crisis and its implications for heterodox economics. I would like to say that Joe, in many ways, has become a leading intellectual force in heterodox economics, in questioning conventional wisdom. And all of us have heard about occupation of Wall Street by the people in the United States. And Joe went there not so long ago and attracted a huge audience and a wonderful interaction in terms of questions and answers with those who were part of the protest. And if you wish, you can read about it. It is available on the net. Joe, may I welcome you to JNU with these few words?
Well, thank you very much. Thank you for those introductions, and it's good to be here. I guess it's not news that there's been a global financial crisis. What I'm going to talk about is not the global financial crisis, but the crisis that there should be in economics about the global financial crisis. Because the standard economic models, hopefully the ones that you weren't taught here, but the ones that are taught in most universities around the world, not only didn't anticipate the crisis, they didn't predict the crisis, but they actually said the crisis of the kind that we had could not occur. Now, obviously it did occur. So something was wrong with the model. So what I'm going to try to talk about is some of the things that are wrong with the model, some of the things that are right with the models, and some hypotheses, some directions that we ought to be going from here. So this is just a brief outline of what I'm going to try to talk about, and I probably won't get through it all, but I'll go fast at some points. Is the failure of the existing paradigm, including the policy frameworks that are based on that paradigm. And then I'm going to try to talk a little bit about explaining the failures, not in the deep sense, but in the sense of what were the assumptions that they made, what were the things they left out in the models. And then I'm going to try to formulate a set of deeper questions that really should be the focal points of modern macroeconomics that really haven't gotten as much attention as they should. And then I'll talk about 4 hypotheses that describe some of the macroeconomic changes that are going on in the world today that are actually may be making it less stable, and that may be contributing to the current economic downturn. As I said, there's a general consensus that something went wrong with macroeconomics. I should say that when I say general, I should maybe put a footnote that among a lot of academics in America, there has not been the kind of learning that you would have expected. Their view, particularly on the right, those who put forward these models have said things like, oh, our models work most of the time. It's like going to a doctor who says, I can care for you if you have a cold, but if you're really sick, that's not my field. And that's really the mainstream in modern macroeconomics. We deal with things when they're not bad, but we don't deal with the Great Depressions or the Great Recessions. There are other views. Look, Ben Bernanke has actually given a speech. Ben Bernanke is the governor, chairman of the Federal Reserve Board. He gave a speech about a year and a half ago in which he said, there was nothing wrong with economic theory. We just made a few mistakes in the implementation of economic theory. And again, I think he's totally wrong. What he was doing was implementing, and I'll give you some examples, trying to implement the models that he helped formulate, and those models were very badly flawed. Not only didn't they predict the crisis, and remember, prediction is the test of any science, and this is the crisis was the most important event in 75 years. If they couldn't predict this most important event, you could argue that really aren't very good. You know, and the models really aren't telling us about macroeconomics. But worse than that, most of the standard models, including those used by the policymakers like Bernanke, argued that the bubbles simply couldn't exist because markets are efficient and stable. In fact, many of the models that are taught in American universities, European universities, and I hope not here, assume that the demand for labor is always equal to the supply of labor. And what does that mean if the demand for labor equals the supply of labor? It means there's no such thing as unemployment. That was a problem when I was chairman of the Council of Economic Advisors. One of my jobs was to hire, we had a vacancy, we had to hire a macroeconomist. And all the macroeconomists coming out of American universities were taught that there's no such thing as unemployment. You have to remember that President Clinton had run on a platform of jobs, jobs, jobs. And so I had this embarrassing difficulty realizing that if I brought one of these macroeconomists into the council and the president said, what do you think we should do about our problem of unemployment? And he said, oh, no problem. There just isn't any unemployment. I would join the unemployment queue. So we had a very hard time finding a macroeconomist that was in tune with what was going on in our economy. Worse still, there are many who argued, all the way from Trichet, the central bank in Europe, that if there is unemployment, it's because of wage rigidities. Major strand going back to Hicks in Keynesian economics, implying countries with more flexible labor markets would have lower unemployment. Well, in this crisis, we've seen what's wrong with that theory. The United States purportedly has one of the most flexible labor markets, and yet 4 years after the bubble broke, 1 out of 6 Americans who would like a full-time job can't get one. 25 million unemployed in the United States. I know in India these numbers seem small, but in the American context, this is a big deal. This is historically unprecedented that we have this level of unemployment for so long. 42% of the unemployed are long-term unemployed. So the question is, how do we rethink macroeconomics? Well, before going into that, I want to talk a little bit in more detail about how these misguided ideas helped frame policy frameworks that are influential not only in the United States but around the world. Monetary policy is the venue in which these often get played out. They argued that maintaining price stability was necessary and almost sufficient for growth and stability. But of course, we've seen that the United States had very low inflation, very stable inflation, and yet we had a major crisis. The Fed said it was not its role to ensure stability of asset prices, and so it let a bubble grow because it said markets will take care of it. In fact, this was part of the central doctrine that markets by themselves are efficient and self-correcting, and therefore one can rely on self-regulation. In particular, there cannot be bubbles. Greenspan went so far as to say, oh yes, there's a little froth in the housing market, but that was all. Another part of the doctrine was, even if there were a bubble, which they couldn't believe there would be, one couldn't be sure until after it breaks. But of course, all policy is done in the context of uncertainty. If you took that view, you wouldn't do anything about inflation until after the inflation had gotten out of control. And so one has to ask, what was going through their minds? And I'll come to that in a second. In any case, they argued, the interest rate is a blunt instrument. Using it to break the bubble will distort the economy and have other adverse side effects. And finally, it was contended that it was less expensive to clean up a problem after the bubble breaks. The implication of all of this was simple: do nothing. And they did that very well. In fact, they did more than nothing. They stripped away the regulations. They created the environment that created the bubble. Each of the propositions on which they rested, though, was flawed. And I don't have time to go through all the points, but let me just say that the focus on inflation targeting is now recognized to be a flawed perspective, that monetary policy has to do more than that. And it was interesting, I was in a meeting at the IMF where even they now have conceded that. The real problem is that focusing just on inflation shifts attention away from first order concerns. And this goes back a little bit to the models that the economists used. The models that they used talked about the distortions that arise when there is inflation. And those distortions are distortions in relative prices, but those welfare losses, the inefficiencies associated with those distortions, are in order or orders of magnitude smaller than the losses that occur when the economy operates below capacity. The loss in the U.S. as a result of this recession is in the trillions of dollars, outweighing all the small, those of you who know these details, the Harbinger triangles that are associated with the price distortions of inflation. So basically, all their models focused on exactly the wrong thing. But of course, underlying all of this was a belief in markets, that markets are efficient, that markets are self-correcting. But there's a general theorem that I hope all of you know, which is that whenever information is imperfect or risk markets incomplete, which is of course always the case, markets are not constrained Pareto efficient. There are always interventions that can make everybody better off. There are pervasive externalities, there are pervasive agencies problems, particularly these are pervasive in the financial sector. Some of you may remember that after the financial crisis, Alan Greenspan was called to testify in Congress what had gone wrong, and he said he had discovered a flaw in his reasoning. Now, you have to understand, a flaw that cost the American economy several $1 trillion he tried to put off as just a little mistake. But what was the flaw? He basically, what he said is, he was surprised that the bankers didn't manage risk better. But I was surprised that he was surprised. Because any economist looking at America's financial sector, India's may not be much better, would have realized that the bankers had incentive structures that encouraged excessive risk-taking and short-sighted behavior. They were motivated to be reckless. And I used to joke before the crisis that if there weren't a crisis, we would have to rewrite our microeconomics textbooks. Fortunately, we don't. Incentives do matter. And they behaved exactly as we would have expected them to. But the important point is that the macroeconomists never understood microeconomics. The macroeconomists incorporated a version of microeconomics that was outdated when they incorporated it. The new classical economists, Lucas and all those guys, incorporated models in which there were no asymmetries of information, no agency problems, no externalities. And they had influence on people like Bernanke and Greenspan. And so in those models, risk was well managed. But obviously, those models left out everything that was important. Well, the existence and pervasiveness of externalities means that there are systematic consequences which market participants will not take into account, and those are the very reasons for regulation. And what was surprising was that Greenspan, who was the chief regulator, didn't understand those reasons for regulation. And it's probably true even today in the case of current regulators. They said, and I've heard even after the crisis, Bernanke say this, there's a strong presumption against bubbles. They no longer say there cannot be bubbles, but they have a great deal of skepticism about that. This is surprising because bubbles have marked capitalism since the beginning. And in fact, bubbles are even consistent with models of rational expectation. And collateral-based credit systems are especially prone to bubbles. Then they said you can't be sure until after it breaks, but all policy, as I said before, is made in the context of uncertainty. But if you looked at what was happening to American housing prices, you could be almost sure that there was a bubble. With those prices going up, if interest rates had returned to the normal level, most people would not be able to afford it. You don't have to have a PhD to know you can't spend more than 100% of your income on housing. And yet, that's what would have happened with normal interest rates for at least a large fraction of Americans. This was the fifth doctrine was that we had no instruments. It's something that one heard over and over again. But in fact, that was a lie. They had instruments. They did not want to use them. Congress gave them the instruments in 1994. The point is, they focused only on one instrument. And I emphasize this is because most of the models focus on only one instrument, and it's the interest rate. But there are lots of other instruments. Leverage, collateral requirements, all kinds of regulatory instruments. They chose not to use them. Why did they do that? And this is really important. The reason they chose not, because they had a simple model in their mind in which they were taught that the only legitimate way of intervening in the market, because the market is efficient, is through price interventions. And therefore, they focused on the interest rate. But when markets are imperfect, as they always are, when information is imperfect, risk markets are imperfect, then one can show that there are other kinds of interventions, including interventions that restrict leverage. So they could have used regulations like loan-to-value ratios to dampen the bubble. Actually, that had been briefly mentioned in one of the Fed meetings during the tech bubble, but it was quickly shot down. And all of this is because of a certain ideological commitment not to intervene in the market. But the curious thing, of course, is that central banks are interventions in the market. So they were intellectually incoherent. That is to say, a central bank is a market intervention. It's setting interest rates, one of the most important prices. If you don't believe in market intervention, they should have resigned from being the head of the central bank and gone off to do something else. So they obviously believed in market intervention, but they had an incoherent theory about what was the optimal set of interventions. Now, there were some old theories back in Friedman's day that said that you should only intervene once. But a whole body of literature, theory of the second best, Ramsey's theorem, and optimal tax theory, Tinbergen, have all explained, particularly in the presence of uncertainty, why one needs to use as many instruments as one can, and that intervention should not be narrowly based. Well, the final part of the doctrine of the Greenspan-Bernanke doctrine was it's less expensive to clean up the mess. I don't think anybody would say that today. The loss before the bubble broke was in the hundreds of billions. The loss after the bubble broke was in the trillions. So what went wrong? Why did the models fail? Well, all models represent simplification. The key issue is, what were the critical assumptions of the standard models? What were the most misleading assumptions? And of course, the answer depends on the question being asked. So, one of the issues here is, what are the issues, or concern, of course, in my mind, is the issue that we ought to be focusing on is the big fluctuations, not the small ones, the day-to-day variations in the economy. What we would worry about are the big fluctuations, like this recession and the other big economic downturns. And the real problem is that most macroeconomic models focus on the little variations, not on the big things. So they get very good fixed, very good descriptions, precisely when we don't care about the answer. But they do very badly when we do care about the answer. Well, some of you may have had to suffer through studying dynamic, stochastic, general equilibrium models. And they focused on three things that are very important: dynamics, uncertainty, and general equilibrium. The key problem is not with dynamic, stochastic, general equilibrium in general, but with the specific assumptions. And the problem is, what they did is to incorporate into a single model complexities of dynamics and uncertainty and general equilibrium that they thought were important, that they left out everything that was important. So I'll talk about a couple of these very, very quickly. They've gone beyond this, but I think this stereotype helps illustrate the point that I want to make. In the beginning, most of the work that they did was on representative agent models, where everybody was the same. Now, the problem with representative agent models is there are no externalities, because with one person, nobody else can be affected. There are no agency problems because everybody works for himself. But if externalities and agency problems are at the core of what is the problem, then you're missing something. This crisis is often described as a financial crisis, but a financial crisis requires somebody to lend to somebody. But if you have one person, who is lending to whom? Well, he can lend to himself, but there's no problem of repayment, because if you lend to yourself, you're going to repay. So all the problems that you think about of asymmetries of information, of lending markets, credit markets, don't exist. In fact, at a very deep level, you can say there can't be asymmetries of information if there's only one person, except that the person has acute schizophrenia. And that assumption is inconsistent with the other assumption of perfect rationality. So by assuming rationality, they assume away schizophrenia, and they assume away all problems of information asymmetries. So the problem, going back 25 years ago, was that they felt they needed to reconcile two strengths: macro, originating out of Keynesian economics, and micro, you might say originating out of Smith and the perfect model. They tried to bring these two together, but they brought them together in a way that was very flawed, because what they did is they took the perfect market model and brought that into macroeconomics. What they should have realized is that macroeconomics was saying something critical about the microeconomics. You needed to reform microeconomics before you brought it back into macro. Macro was providing a good description based on a microeconomics. It was the micro that was wrong. And over the years, over the 30 years, we've actually reformed microeconomics with game theory, imperfect competition, imperfect information. So the microeconomics is actually on a much more solid foundation, but macroeconomics still played in this world with perfect markets. Now, to be fair, there's in recent years in macroeconomics, they've been engaged in what is I call a Ptolemaic exercise. I don't know if you remember Ptolemy in astronomy, where the simple models where the Earth was at the center and everything went around didn't describe the world well. And astronomers, even 2,000 years ago, realized that. And the people were very bright, and they kept figuring out more and more and more complicated ways to reconcile the model that was wrong with the data. And that's what the macroeconomists, the Chicago macroeconomists, have been engaged in, the Minnesota macroeconomists, for years, but in fact, it's exactly that. Gone so far that in most of the modern macroeconomists, they've given up econometrics. They do curve fitting. So they say, can we find a set of numbers that look like the world? Not fit the data, not test it statistically, but just sort of look like it, and choosing some aspects of to look at. So in fact, they've even given up sound statistical practice in their Ptolemaic exercise to reconcile. Well, among the things that were left out, there are two I want to mention in particular. One is the distributive issues. If everybody's the same, distribution isn't important. And the second is the credit issues, because financial markets played a very big role in this crisis. On the first, let me just give you an illustration of how distributive issues are pervasive, and we'll come back and see some more later on, are pervasive in the analysis. When you lower interest rates, the argument for lowering interest rates is that it stimulates investment. But right now, lowering interest rates is having almost no effect on investment. Why? Well, two reasons. One is the banking system is still broken, and the money doesn't pass from the Fed down to the small business that wants the money. So that's the second one. Is that many firms have excess capacity. 40% of all investment before the crisis in the United States was in real estate. And we have empty office buildings, empty houses all over the country. So just because you could borrow money at a little bit lower interest rate, would you build another empty office building or another empty house? The answer is obviously no. So the interest elasticity of investment is very low. So you lower interest rates, you don't get much additional investment, but what you do happen is that you have all the older people in the United States, not all of them, but many of the older people are dependent on savings. And those who were prudent put their savings into U.S. government bonds. You lower the interest rates, and what is the interest that they're getting on U.S. government bonds? Close to zero. So you're starving the older people, their consumption is going down, and you're not getting any more investment. So a model that takes into account distribution would realize that lowering interest rates may, under these peculiar circumstances, not stimulate the economy, may actually have a negative effect. So that's an example of something first order that should have been in the model, wasn't. Second example, credit markets. The breakdown of the system, Lehman Brothers, the collapse of Lehman Brothers, the collapse of interbank lending. The remarkable thing is that the models of most central banks do not include banks. They don't have any banks in those models. So the central banks are based on models that ignore the importance of their very institution. Very strange. But this is what happens when you have ideology driving science. So what they believe is that you increase money, and money mysteriously goes into the economy. And in good times, that may be the case. But when the banking system gets broken, that doesn't happen. And the banking system is broken. But when it broke, people turned to the Federal Reserve and they said, fix it. And obviously, they didn't know a thing about that. That wasn't their business. These were macroeconomists, but they had never thought about how do banks run. I'm a little bit exaggerating here, but obviously not enough. So after the subprime mortgage crisis broke, people asked Bernanke, are you worried? He said, no, we have the crisis contained. Obviously, his models were totally out of line with what was going on in reality. So, I want to talk now about what I think should be the three major questions that macroeconomists ought to be focusing on, and then give a little bit of a hint of what I think are the answers. I'm particularly interested, obviously, in the big fluctuations, not the small day-to-day fluctuations in the economy, the big events. The first is, what are the sources of disturbances to the economy? Those of you who study real business cycle know that in the mainstream in macroeconomics today, the sources of the disturbance to the economy are exogenous shocks. Technological shocks coming from the outside, assumed exogenous. But if you look at this crisis and the Great Depression, it wasn't an exogenous shock, it was man-made. The bubble was created by bad regulation. We could debate about what were the monetary policy, but it was clearly a man-made shock. And so the traditional theory ignores these man-made shocks, which are enormously important. They repeatedly occur. To some extent, they are a result of irrational exuberance, and to the extent that that is true, there is a need in economics to study irrational behavior. And there's ample evidence that there is irrational behavior. One of the other flaws in the standard theory is it assumed rationality. And we have ample evidence, and I could go through in my book Freefall, I document all the ways in which you could not reconcile what was going on in America's mortgage market with any model of rationality. So part of it is clearly some degree of irrational behavior. Because it's irrational doesn't mean it's unpredictable. There are systematic patterns of irrationality. And that, of course, is the focus of behavioral economics. So what's interesting is that there are even now models of rational herding, rational behavior, which can give rise to bubbles. And it's important from an analytic point of view to know what are the structural properties of an economic system like collateral-based lending that makes such kinds of bubbles more likely, and what are the policies that can make it less likely. The second aspect of puzzle is the economy is subjected to fast declines, and the third is that they're subjected to slow recoveries. And let me explain both of those very quickly. The fast declines, normally when we write down a supply and demand curve, if we have a shock to the system is designed to absorb shocks. We have inventories, we have price adjustments, we have lots of systems in our economy that help buffer the economy. Shock absorbers, you might think of them. And they enable the system to adapt to the inevitably large numbers of shocks that it faces. On the other hand, there are certain times when the economy, rather than absorbing the shock, seems to amplify the shock. A small shock gets bigger and bigger. And the question is, what are the structures, the characteristics, the circumstances under which economic systems, rather than dampen buffer shocks, amplify them? And obviously, when the economies have that structure, when they're hit by a shock, then they can fall, a negative shock, they can decline very quickly. The third puzzle, in a way, is the slow recoveries. Even after we have a crisis, even after the financial markets didn't do a good job of allocating capital, they misallocated, they created the bubble broke. Standard theory says the following: after the crisis, we had the same capital, labor, natural capital, human capital, physical capital that we had before the crisis. If markets worked well, what should happen? Those resources ought to be fully used. This talk about leverage, that's irrelevant. The fact is that there should be an adjustment of wages and prices and interest rates and whatever the factors, so that whatever the capital, we have less capital than we would have had we not wasted the capital in the market failures that existed before the crisis. That was the market failure. But now that we've recognized we made a mistake, the bubble broke, why aren't we using our resources well? And in fact, the irony is that the greatest waste of resources occurs after the bubble is discovered, after the bubble broke. In the bubble, we lost hundreds of billions of dollars. After the bubble broke, we lost trillions of dollars. And the question is why? It's a market failure of an enormous magnitude. And none of the theories in macroeconomics really explain the failure to adjust to get the economy going again. So those are the two puzzles, and I'm just going to, I don't have time to talk about them very much, but the basic argument is that the large changes in the state of economy from small changes in state variable can be the consequence of important nonlinearities in the economic structure, which should be familiar from the old nonlinear business cycle models. But probably equally important stuff that I focused on is the role of credit constraints. The credit constraints lead to the end of the bubble, and they help amplify the economic downturn. And so, in fact, this gives rise to what is sometimes called the financial accelerator. And I'll come to a little bit later into some aspects of this that have to do with some non-convexities in the economic structure that, in fact, lead to a process of trend reinforcement, so that as the economy goes down, it goes down at an increasingly fast rate. Uncertainties and the imperfections in risk markets exacerbate these decline. Well, the argument for the slow recovery is somewhat different. In my mind, the real fight here is another redistributive battle. The battle over who bears the losses. Basically, what's happened in the United States and many other countries right now is that there are more claims on resources than there are resources. That is to say, the value, if you add up the value of the mortgages and the value of people think they own more than they do. And the question is, who's going to take the loss? And as we fight over who's taking the loss, what is happening? the size of the pie that we're fighting over gets smaller. So this is a major distributed battle. How do we normally solve this problem? In effect, what we have right now in the United States, to put it in a way, graphically, about 1 out of 4 American who have a mortgage owe more on the mortgage than the value of their house. They're underwater. So the value of the loan exceeds the value of their house. Now the question is, somebody's going to have to take a loss. That's clear. But the banks don't want to admit it, because if the banks admit that they're going to take a loss, what will happen? The banks will be underwater. They'll have to be recapitalized. They don't want to do that. The government doesn't want the banks to do it, because the government knows it has regulations that require the banks to be capitalized, and the banks, they know the banks can't get the capital. The government will have to give them the capital. The government doesn't want to give them the capital, so the government is encouraging them to be dishonest. We changed our accounting rules after the crisis. Some of you may know that we have accounting rules that are called mark-to-market, where you're supposed to write the market value, write down the value, the mortgage to the market value. It's called mark-to-market. Well, in April 2009, we changed the accounting rule from mark-to-market to mark-to-hope. That is to say, a mortgage that was not performing, you could treat it as if it were perfectly good. As long as you, with prayer, it might fully repay. So as long as it had not said it was not going to repay, you could pray that it could repay, and you could treat it as if it would repay. And of course, it's all fictitious accounting. But the fictitious accounting was extraordinarily useful, because the banks could say, look at our assets, they're all very good. We don't need more capital. And if you hear banks every once in a while say, we don't need more capital, part of the reason is they're using fictitious accounting. The bank in Belgium and France that went bankrupt a couple weeks ago passed a stress test 2 weeks before. It said it was perfectly healthy. And that tells you how much you should trust the accounting frameworks of the regulators, of the banks. So the answer is that eventually we're going to have to sort out these excess claims. But no one wants to do it now. They want to postpone it. So one way we do it in the past has been inflation. How does inflation help? Well, inflation helps because the real value of what is owed goes down to the point where what is owed is less than the value of the house. But there's an inflation paranoia in the world today. Central bankers don't like inflation, and the result of this is that we're not likely to get inflation. There's another way of doing it, which makes an eminent sense, which is bankruptcy. You restructure debt. But the bankers don't like that either. And the bankers happen to be running the government in the United States, so that hasn't happened. There have been bills to try to do it. I've argued for what I call it a homeowners Chapter 11, that businesses, if they owe more than they can pay, get to restructure their debt, because we believe, and do it quickly, because we believe that it's important to keep businesses in business, to keep jobs, and to keep the economy going. And I've argued that it's equally important to keep families in their homes, to keep families and communities alive, that it makes no sense to have homeless people in empty homes, which is what we're creating. 7 million Americans have lost their homes in the last couple years, and 4 million are expected to lose their home in the next couple years. But again, that the banks have resisted this kind of reform. So in the absence of these ways of adjusting, either inflation or asset restructuring, what we are doing is a third course, which is sometimes called muddling through. And one of the reasons, which means doing nothing, which is one of the reasons why this economic crisis is likely to last that much longer. It's interesting, one of the countries that had the worst crisis in the world, Iceland, where its banks were a multitude of the size of their economy, their crisis was so large that they couldn't do what the experts said you ought to do. So what they did is they didn't save the bankers. They restructured the mortgages, and now their economy is not in perfect shape, but much better shape than most of the countries of Europe and America, even though they began with a much greater crisis. So they understood this issue of that unless you do something dramatic, you're going to have a slow recovery, and they've managed to recover much more quickly. Well, I want to now talk about four hypotheses that maybe help understand the current macroeconomic situation and why the economy not only is in a downturn but has been so persistently in a downturn in the West. The first is that there have been large and often adverse changes in the economy's risk properties in spite of supposed improvements in the markets. Secondly, there have been deterioration in the information. Moving from banks to markets predictably led to deterioration in the quality of information. Thirdly, structural transformations may be associated with extended periods of underutilization of resources. And fourthly, especially with information imperfections, market adjustments to perturbation from equilibrium may be destabilizing. I won't have time to talk about all of these, but let me talk about several of these. But the underlying theorem is the one that I mentioned in the beginning. Markets are not in general Pareto efficient once asymmetries in information and imperfections of risk markets are taken into account, nor are they stable. They are not necessarily stable. Most of our economic theory focuses on equilibrium, but not on adjustment. And under a variety of conditions, economic responses to disturbances is unstable, but we can help alter the economic structure that can make it more or less stable. So let me talk about a few of these ideas. First on risk. Here, what I would argue is that a central question in macroeconomic analysis should be an analysis of the economy's risk properties, how it exposes itself to perturbations, to risk, how it amplifies and how it dampens shocks. And there have, in fact, as I said, large and adverse changes to the risk properties. Let me just mention a couple of these. One of them is financial market, capital market liberalization, which has been a fad for the last 20 years, exposes countries to more risk. Most of the disturbances to small open economies have come from outside their market. And we've been seeing that recently with the disturbances from Europe. Capital adequacy standards, rigidly enforced, can actually act as automatic destabilizers. In the United States, we had floating rate mortgages, which are kind of mortgage, which acted also as a destabilizer. I could go on with other changes. The move from defined benefit to defined contribution Social Security system acted as a destabilizer. One of the real problems is that we paid insufficient attention to the architecture of risk. The theory was that diversification would lead to lower risk and more stable economy. It didn't happen. And the question is, where did the theory go wrong? And here, it's both the economics and the mathematics is important. The reason that Bernanke said, don't worry about the subprime mortgage, the $1 trillion of subprime mortgages going bad, he said, $1 trillion, what's that in the global economy? It's a small number. And what he said is, we've diversified it around the world. And he had, to some extent. When I give this talk about this in Europe, I always thank the European audiences because they bought about 40% of our toxic mortgages. And I say, thank you. If you hadn't done it, the American downturn would be much worse. And also thank you for deregulation, because if you had good regulation, they wouldn't allow you to buy our toxic mortgages. So it was a double thank you. But in terms of the mathematics and the economics, the models that are taught in economics have make strong assumptions of convexity, make strong assumptions that the more you spread risk, the more stable the system. Aspect of diminishing returns. But in fact, if we take a closer look at economic structures, non-convexities are pervasive. Bankruptcy, learning effects, R&D, all of these can lead to very strong non-convexities. In fact, this kind of intellectual dichotomy is reflected in much of the standard debate. Before a crisis, the IMF and other economists always talk about diversifying risk, open up markets and spread risk. But what do they say after the crisis? What is the word that they use all the time about the world after the crisis? They use the word contagion. If you write down a model of contagion, the word contagion originates from contagious disease. Okay, contagious disease. What do you do with people that have contagious disease? You quarantine them. You don't want contagious diseases to be diversified. You don't want to spread it around. You want to isolate it. Well, if you look at the mathematics underlying contagious disease, it exhibits this non-convexity. So in their mind, this is a kind of cognitive dissonance that was pervasive. In their mind, they thought of two worlds. Before the crisis, they believed in convexity. After the crisis, they believed in non-convexity. But of course, it's the same world before and after the crisis. And you needed to have a model that integrated both of them. If you thought about it in an integrated way, you would have said, there may be benefits of integration, but there may be dangers, and we have to think of frameworks that get us the benefits and limit the dangers. And one of the ways of doing that, for instance, might be to impose capital controls. When things get out of control, we'll limit the downside risk. Interestingly now, I don't know if you've been following this, last April the IMF finally came out in limited support of capital controls, a very major intellectual change on the part of the on the part of the IMF. Let me give you a little bit of an analogy here that maybe help illustrate what I'm talking about. A different area, but those of you who background in physics might understand this. There are big benefits of integrating electrical grids because you can save on generating capacity. You want a certain probability to make sure that you can generate all the electricity that's needed, and the larger the electric grid, the smaller the generating capacity to be able to make sure that you can meet the electrical demand, say with a 99.9% probability. And so that has been a motivation for creating integrated electric grids. But what is the downside of creating integrated electric grids? And we saw that in the United States a couple of decades ago. The downside is that if you have a problem in one little place in Ohio, it could bring down the whole electrical system for the whole east coast of the United States. With an integrated electric grid system, a failure in one part can bring down the entire system. If you had isolated systems, that can't happen. So electric engineers work very hard to create circuit breakers to make sure that you can get the benefits of integration, but without the risks that come with that. So they recognize there are benefits and there are risks, and they've brought the two together. Well, capital controls are a little bit the analogous thing to circuit breakers, and can enable us to get some of the benefits of integration. So my own research has shown that in the absence of these circuit breakers, full integration will never be desirable. And in fact, capital market liberalization can increase consumption volatility and may lower expected utility. That a whole body of research that shows that unconstrained interlinkages can make economic financial systems more less resilient to large shocks, which is exactly what we saw in the crisis, where a problem in one part of the financial system quickly spread around the entire economic system. So this has actually become a very active area of research in the last couple of years. Interconnectivity can help absorb small shocks, but exacerbate large shocks, can be beneficial in good times, but detrimental in bad times. Interlinked systems are more prone to system-wide failures with huge costs, and this is illustrated by the current crisis. And this is a reference to some of my own work trying to develop this framework and some mathematical models. Let me just skip through them. The important point about all this is that the design of an economic system, interrelations, interdependencies really matter, and that important area of research is to help design this better. Let me just. The second point is that information imperfections and asymmetries are central. They explain credit and equity rationing, why banks play a central role in the economy. But many of the institutional changes that have been going on are actually having an adverse effect on the quality of information. One of the important changes that has occurred in recent years has been securitization. And everybody talked about securitization as improving the risk properties of the market and made the market work better. But securitization, while it improved the risk properties, had adverse effects on the information problems. Because with securitization, nobody had any incentive to really monitor the individual loans that were going into the security. And in fact, what you did by diversifying risk, you also diversified accountability, and in fact, totally undermined accountability. So the result of this is that, in fact, the problems that we have seen in the failures in the securitization market in the United States, I would argue, were not accidental. They are inherent, and there is no easy fix. And the interesting thing is that in the United States, in the aftermath of the crisis, the securitization market of mortgages has not been restored. In fact, the U.S. government now is totally funding almost all of the mortgages in the U.S. The private mortgage market remains effectively dead. And this is years after the bubble broke. The third point, and I'm running out of time, let me make this very quickly, is the following. We were told the banks behave badly, the banks are broken, let's fix the banks, let's stimulate the economy until the banks get fixed, and once the banks are fixed, the economy would turn back to normal. But we fixed the banks, or almost fixed the banks, not quite, but done most of it, and the economy is not back to normal. Unemployment in the United States is still 9.1%, and as I said, 1 out of 6 people who would like a full-time job can't get one. And that raises the question, what's wrong? Well, part of the answer is to think a minute and go back to 2007, before the crisis. The economy was sick. Why do I say the economy was sick? Well, what kept the economy going? What was the basis of the near full employment that we had at the time? What kept the economy going was a bubble. The bubble supported a savings rate that was 0. So we went back to 2007, we would go back to an economy that was still sick. If we went back to 2007 without the bubble, we'd have high unemployment. And that's basically what we're doing. But it's actually worse than that. Back in 2007, one way of thinking about it is 80%, the bottom 80% of Americans were consuming 110% of their income. When we fix our financial system, they're not going back to 110. Maybe there'll be 100, but it won't be 110% of their income. So that raises the question, what went wrong? Why was the economy weak before the crisis? And there are a number of explanations. One of them that Bruce Greenwald and I have been exploring some models. One of them is that this is a period of structural transformation akin to the structural transformation of the Great Depression. In the Great Depression, America was moving from agriculture to manufacturing. The reason for this was a success. Agricultural productivity was rising very rapidly. In the 19th century, 60% of all people were engaged in farming to produce the food that people need. Today, 2% of Americans produce all the food that even an obese society can eat, and then we still export. So that's a success, but people had to move out of farming into something else. And the problem is moving that kind of structural transformation is not easy. In fact, it's very difficult. And there can be a very dangerous, vicious circle. What happened between 1929 and 1932 is prices of agricultural, incomes of agriculture in the United States fell by 50%. And so you had all these farmers that wanted to move out of agriculture but were trapped. They couldn't afford to move. And meanwhile, because their income was going down, they couldn't buy the goods in manufacturing, and so there was unemployment in manufacturing. So there wasn't any place for them to move. The New Deal was too small to deal with this. It wasn't until World War II that we had a big Keynesian stimulus, but it was a very interesting Keynesian stimulus. It stimulated the economy, a lot of government spending, but it was also an industrial policy because the war required moving people from agriculture to the cities to manufacture, not good things, but things that we needed at the time, munitions, airplanes. And then after the war, they transferred from manufacturing arms into manufacturing consumer goods. So we did that structural transformation very quickly as a result of the war. But there was one other aspect, because during the war, people were not allowed to consume. They built up their savings, and so after the war, we had a pool of savings that was the demand of the goods that they could produce. So we solved the demand and supply problem and the structural transformation problem simultaneously. Well, you can see what the analogy is today. We're now moving from manufacturing to the service sector. Incomes are falling rapidly in manufacturing. They really are falling in the United States. Wages are falling. The wage of an unskilled worker somebody's not graduating from a high school is 28% below what it was 3 decades ago. The typical full-time male worker in the United States, income today is as comparable to what it was in 1978. So there's total stagnation in the United States for the working class. And so they're trapped, they're unable to get the skills they need to move into the service sector. And so the argument is that we need a very large government program that will actually make the transformation. Let me just conclude so we have time for questioning. This crisis combines elements of increased risk, reduced quality of information, structural transformation, with 2 more ingredients: growing inequality domestically, which would normally lead to lower savings rate, and growing global reserves. Both of these are dampening the global economy. What we need now is a new macroeconomics. It should be clear that standard models were ill-equipped to address key issues discussed. Assumptions ruled out or ignored many of the key issues. Many of the risks represent redistributions, and how these redistributions affect aggregate behavior is central. So what we need is a new macroeconomics that incorporates all the elements that I talked about with greater sensitivity to the assumptions, including the mathematical assumptions that effectively assume what was to be proved. So let me just conclude. Models and policy frameworks, including many used by central banks, contribute to their failures before and after the crisis, and in fact provide little guidance on how to achieve growth with stability. Fortunately, there are new models that can provide alternative frameworks. Many of the central ingredients are already available. We have models with credit availability, models with credit interlinkages. We have models that incorporate agency problems, externalities, a broader set of market failures. We have models based on rational behavior and rational expectations, and as well as behavioral economics. So I think going forward, it's less likely that a single model, a simple but wrong paradigm, will dominate as it has in the past. There are, of course, always trade-offs in everything, including in modeling. Greater realism in modeling banking or modeling the shadow banking system, or greater realism in modeling the distributional issues, key financial market constraints, will necessitate simplifying in other less important directions. And that is really the key lesson for, I think, macroeconomics for analysis. What they did is they focused on the wrong things. And the question is to try to figure out what are the right things. The thing that they focused on were the complexity arising from intertemporal maximization over the infinite horizon. And these were just of far less importance than those associated with an accurate depiction of financial markets. They focused similarly on price stability, but they should have also focused on the stability of the financial system. So we need not only new models, we need new policy frameworks developed based on these new macroeconomic modeling. As I say, I think the good news is that we have today many of the pieces to construct the new macroeconomics model. And so if we have a greater clarity of what was wrong with the old models, I think it'll give us some guidance of how to construct the new ones. Thank you.
On behalf of all of us, I'd like to thank Professor Stiglitz for what has been a scintillating lecture that explored the interconnections between and the intersections between microeconomics and macroeconomics, theory and policy, economics and politics. I think it underlines the significance of heterodox economics at the present conjuncture, so that it can question conventional wisdom, so that it can question economic orthodoxy. And I agree with Joe that we have reached a state in reconstructing macroeconomics in terms of our understanding of what went wrong and what could be done. We need to be able to diminish the influence of economic orthodoxy on political processes. And it's a struggle because economic orthodoxy represents vested interests, represents class interests, represents the financial sector, which have grown enormously in influence. The only thing I might say in hope and optimism is that what we have to say is in the interests of the people. And in the ultimate analysis, there has to be some balance between market economy and political democracy. I'm going to shut up. We have very little time. 15 minutes for Q&A. And you will have to allow me the privilege of a dictator as chairman, because I'm going to take 3, at most 5 questions. No comments, no speeches, please. Just questions. I'll take 1 question from each segment of this auditorium, and I see 3, okay? I'll give preference to young people and students. Yes, the young lady over here. Just one moment. I'll come to you. Please be brief.
Hi sir, plus it's a pleasure to see you out here. But my question out here is something very simple. You talk about interconnectivity, right? And you said that it can sort of exaggerate the losses at times, like we have actually seen it in the European crisis. But we also know India, for that matter, has gained a lot through liberalization and globalization. What do you think is the way out? Are there specific sectors that should be regulated? What should be deregulated? And yeah, that's about it, I think.
Thanks. Yes.
Professor Stiglitz, I mean, one of the things which I've seen is there's been a phenomenal rise in economic inequality in the United States, and all this while before the crisis. And this is something which we are seeing in our country also. There's been a rise in economic inequality with neoliberal policies. So what do you think has been the role played by the increasing economic inequality in the crisis, and what implications do you think should macroeconomics learn from and the crisis and the lessons?
Thank you. Yes, please, go ahead. That gentleman.
Considering 20 years back, Japan has followed similar problems, and we seem to have learned nothing from the Japanese experience. Was it really surprising to me that US, after seeing the real estate crisis in Japan, the prolonged recession, aren't we seeing something similar happening in the US now?
Thank you. I'm going to take 2 more questions. The lady over there, yes, you raised your hand first. No, the one next to you. Yep, please. Yes, and I will allow you.
Thank you very much for your talk, Professor Stiglitz. I'm here from the US studying at JNU for a year, and the big question on many of the minds of students who have studied in the US is college debt, is student debt the next bubble?
Yes. Over here, please.
I have to ask this question as a very important question for our country. Joe, the question is that I've read your book, Global Crisis, A Way Forward.
Question.
Question is in the transparency and incentives, vested interests. So how does the government direct the private institutions to change the behavior, keeping in mind the social conditions of the country, and especially the developing countries? Thank you.
Professor Stiglitz, I think I should give you the time and the opportunity to respond to this, and we'll see if there's time for another round.
Okay.
Would you like to use the podium?
Oh, okay.
Well, Let me first take up a couple of the related questions. Inequality, I think, has played an important role in the current crisis, and this was a theme that was taken up by the UN Commission. And interestingly enough, even by the IMF, in their meeting in April, the managing director said that the IMF was going to focus much more on inequality because they've been convinced that inequality is related to instability, and stability is their mandate. So there's a growing global consensus that there is some link between instability and inequality. Let me try to describe very briefly what the link as I see it, and it's a complicated story in part. But one way of, another way of seeing what was going on in the United States was that the degree of inequality had increased very markedly over the last 20 years, and particularly in the last 10 years. And the propensity to consume of those at the top is much lower than those at the bottom. So when you redistribute income in that way, aggregate demand goes down. It was made worse in some ways by the consequence of the Iraq War that meant that the price of oil went from $23 a barrel to over $140 a barrel, which meant Americans were, what they were spending was not spending goods on the United States but abroad. So there were some particular events that exacerbated it, but the net effect of all this was that aggregate demand was weaker, would have been weaker. So how did the Fed respond? The Fed responded with this weak aggregate demand, would have been weak aggregate demand, by lowering interest rates and stripping away regulations. And that created the bubble. So in effect, what I mentioned before, you know, the incomes in the United States have been going, for most Americans, have been going down for year after year. So even today, incomes of the median income household is lower than it was in 1997. So incomes have been going down, and they said, well, don't let that bother you. Consume as if your income was going up. And Americans were very good at that. Now, how do you consume as if your income is going up when your income is going down? Obviously, debt. And so that is, in a sense, one interpretation of the debt bubble is that it was the way we reconciled this declining income with the demand. Some people have talked about, in terms of political economy, a political demand, keeping consumption. What made it all possible was the bubble. And that's not going to be possible now. Hopefully. They will try to have another bubble. And that's why when you hear every once in a while, you'll hear from somebody at the Fed or the administration, the American consumer is coming back. That's nonsense. Because the only way it would come back would be if he could go back to this world of the bubble, where the bottom 80% were consuming under 10% of their income. So that's the fundamental problem. Now, the difficulty is that when you have an economic downturn, it makes things worse. Because what happens when you have an economic downturn? High unemployment, downward pressure in wages, greater inequality. So you get a vicious circle, so you don't get out of it. It's an unstable system, so things get worse and demand gets even weaker. And that's why the view that the problem isn't wage flexibility, wage rigidity, wages are going down, and that is hurting aggregate demand. Now, there was a question about, at the beginning of this crisis, people felt so good that Bernanke was at the Fed because he said we wouldn't follow the Geithner, both of whom had looked at Japan and said we wouldn't follow the example. But what do we do then? We follow the example. So there were a couple lessons. It's always difficult to figure out what are the right lessons. And what are the right lessons of the Great Depression? Bernanke was a student of the Great Depression. One lesson is that you need to fix the banking system. But what part of the banking system do you need to fix? Why do you care about the banking system? Because you want money to go to the small and medium-sized enterprises that need to borrow. The big companies don't need to go to the banks. They borrow on capital markets. It's the small and medium-sized enterprises that are dependent on the banking system and the credit flow. But when Bernanke and Geithner got around to trying to fix the banks, who do they focus on? The big banks that don't do lending, that engage in speculation trying to bring Greece down. That's who got all the money. Over 300 American small banks have that actually are involved in the lending have already failed. 800 are on the watch list, about to fail. The credit supply to small and medium-sized enterprises is constrained. So we didn't fix the banking system. Part of the reason is they didn't understand banks. So what they did is they gave money to the banks, but they said, oh, we'll trust the banks. Why do we trust the banks after they got us into this mess was beyond my belief. But they said, we don't want to put constraints on the banks. So they gave the banks money, and what did the banks do then? Pay out the money in bonuses and dividends. Totally predictable in any model of banking. But they didn't have models of banking. They just had they had their models of their friends, and they knew what it meant to give money to your friends. And so that's what they did. And that's why you talk about Occupy Wall Street, why there's such anger, is they say, look, the money went to help the banks, but where did it didn't get to the rest of America. It didn't really help the American economy. And there's, on both the left and the right, there is rightly, I think, a lot of anger about this. But as I said, it's always difficult to figure out the right lessons, because the other part of the story that I emphasized in the towards the end of my talk was this, there's been a big debate about the right interpretation of the Great Depression. Was the problem of the Great Depression caused by or amplified because the Federal Reserve did not increase the money supply enough? If only the Fed had increased the money supply ernoughh, then the Great Depression, at least the depths of the Great Depression, would have been avoided. That has been the conventional wisdom and works of Bernanke and so forth. Well, that theory has been totally demolished by this crisis, because what happened? The Fed turned on the money supply, the spigot, more than anybody could have even imagined. The base money increased by threefold, from 800 billion to 2.5 trillion. And what happened? Well, we avoided the Great Depression, but we still have a very deep and extended recession and no hope out of sight. So the answer is more than that is going on. More than that. And that is the story that I just told before about the structural transformation and the story of inequality that I mentioned. So these are deep underlying things which fixing the banking system doesn't solve. So fixing the banking system, this is really why this is so complicated. Fixing the banking system is necessary to get us out of the downturn, but it's not sufficient. And we haven't really fixed the banking system, and we haven't addressed at all the underlying problems. Now, the question, I mentioned that I think globalization has some big advantages. India and China have been beneficiaries of that. But obviously, interconnectedness can also lead to volatility that we've seen in the recent crisis. And how do you balance that? And the answer to that goes to the point that I tried to raise in my talk, that one has to design economic systems where you take advantage of the advantages and protect yourself against the downside risks. And that's why if you focus on financial sectors, you, for instance, have circuit breakers, which are equivalent to capital controls. Or the other thing, if you look at the different kinds of finance, No one has ever been able to show that opening up capital markets to short-term capital flows increases economic growth. It does increase economic volatility. So that's an example of a kind of capital market integration that has no benefit and just a cost. And there are good theoretical reasons why you should expect that to be the case. China has not opened itself up to short-term capital flows. As you get more developed and integrated, it may be more and more difficult to create, to manage these short-term capital flows. But the China's success has been based on the fact that they have not opened themselves up, and that's enabled them to have a more stable financial system than they would otherwise. So I think part of the answer is to think very carefully about what parts of globalization, integration bring benefits, and the parts that have costs, can you manage them? Like through capital controls. Another way of thinking about this in terms of, we've had a lot of discussions on what are called capital account management regulations, financial sector regulation, and there's been a very big mindset change after the great global crisis. The notion that the view that it is good to have deregulated, liberalized capital markets, I don't think anybody supports that anymore, except a few bankers who make money out of instability. And there are people who do make money out of instability. Anyway, but the view that you need some form of financial market regulation seems clear. And the question is, how do you design it optimally? What is the best way of doing it? But another point that is very clear is that regulation of cross-border flows needs to be different from regulation of flows within a country, because they're affected by different forces. So the notion that governments need to take into account that there are some distinctive aspects of cross-border capital flows and have regulatory systems directed at cross-border capital flows, again, it seems to me, now almost universally agreed upon. And even, as I say, the IMF now has changed its views on this topic, not as much as I would have liked, but still moved in the right direction. One aspect of financial markets is that they are always looking for trouble. And you solve one problem, and there will be another one. And that's just life with financial markets. All I can say is, you should be, those who are involved in regulation know that their task is never done. There's a lot of discussion, for instance, that India had your little version of America's subprime in some of the microcredit lending schemes. That there are always people who are willing to engage in predatory lending, take advantage of people who are less educated, uneducated, poor. The way I put it in describing in my book Freefall, I describe, basically one of the things that happened in the United States is there was a famous book written a few years ago about there's money at the bottom of the pyramid. The bottom, there are a lot of people at the bottom each have very little money, but there are a lot of them. And so in aggregate, the total amount of money at the bottom of the pyramid was a lot. And the bankers discovered it and said it's wrong for it to remain at the bottom. And they worked very hard to move it to the top. And that has been the American business model. And unfortunately, some of that business model has been extended to India, and some people were working very hard in microcredit on the same principle of moving money from the bottom to the top. And it had some problems in the microcredit. Well, in the United States, one of the areas where some of the very bad lending practices occurred are student loans. This has been, and this is a real example of vested interest, well known the worst performing student loans are in private schools. Let me make it clear. The worst performing schools in the United States are the private schools. We have three categories of schools. So let me distinguish and make sure you don't get confused, because the public, the state schools, then they're not-for-profit, places like Columbia, Harvard, that are not-for-profit. And then there are a limited number of for-profit that have been growing very rapidly. And the for-profit schools' business model, for the most part, is to try to find poor people to exploit and take advantage of, and get them to sign up, get a student loan, give them no education, they don't get a job, then they don't pay back the loan, and they're saddled with the loan. And this is now amounting to billions and billions of dollars. This is a major problem. When I was in the White House, we tried to stop this and said that if your graduation rate or your non-payment rate is below a certain level, you're not eligible for government loan programs. And of course, the lobbyists from the financial sector and from the private for-profit universities lobbied successfully against these efforts. Well, the consequence is the student loans are now increasing, except that they are worse than, in some ways, the amounts are smaller than the subprime mortgage, so it won't be the macro. But for the individuals, it's worse, because whereas we only have a partial form of bondage slavery, bondage for ordinary debts, we have full bondage for student debts. Let me explain what I mean. In the Bush's bankruptcy reform, he did a lot of bad things, but one of the bad things was so-called bankruptcy reform, to make it more difficult to discharge debt. So that today in the United States, if you have, it's very easy, say somebody with a $50,000 income winds up with a $50,000 debt. He can't go to bankruptcy court and get it discharged. He will have to pay for the rest of his life 25% of his income to the bank. Because what happens is the bank is allowed to charge him 30% interest. He then pays 25% of his income to pay down the debt, but the interest charge at 30% more than offsets the 25% that he's paying. At the end of the year, he owes more. The rest of the life, he gives 25% of his income to the bank. And this is unconscionable. But in student loans, it's even worse. You cannot in any way get discharged from your debt, no matter what your amount is. So the bankers got together with the private guys and made it difficult to get out from under, and it's a good business model, except one, it's really socially destructive. The final question, if I understand it correctly, had to do with, let me answer it in a very broad way, the governance of the Federal Reserve System has been a subject of a great deal of discussion, particularly, again, in the aftermath of the crisis. One of the ironies is that in the East Asia crisis and in elsewhere, many countries were told, adopt American-style institutions and the regulatory systems. And the Federal Reserve was put out there as a good model. No one in the United States believes that the Federal Reserve is a good institution today. And there's almost unanimity from the left to the right, except for the bankers, that the Federal Reserve is a deeply flawed institution. And let me just give you a couple of examples of, and then some of the discussion of reform. The example that most probably outraged people was in the bailout AIG, I don't remember, one insurance company, got bailed out $150 billion. Now, I don't know, India is a big country, but I think $150 billion is still a lot of money. It's huge. And to give you a little bit of a framework for this, President Bush had vetoed a bill to provide health insurance for poor children in the United States because we don't have a public health system. He vetoed a bill for health insurance costing a couple $2 billion a year, saying we couldn't afford it. And a couple months later, he found $150 billion for AIG for one company. And of course, Americans wanted to know, where did all this money go? It just whoosh, disappeared. And Bernanke said, I'm not going to tell you. And we said, aren't you part of the government? And he said, no, we're above the government. And Bloomberg sued. We have an important law called the Freedom of Information Act, the Right to Know law, and went to court, and the court said, you have to tell. And he said, no, I don't. I said, I'm above the law. So he appealed to the next level, the appellate court, and they said, you have to tell. And he said, no, I don't. And he was going to appeal to the Supreme Court when finally the administration said, you are part of the government. You are accountable. But of course, by then we all knew, the good thing is that there are leaks and you know what was really going on. And we all knew who was the biggest recipient of the Federal Reserve money, of the $150 billion. And guess who it was? Goldman Sachs. And the next biggest recipients were all foreign banks. And so the question was this to save the American banking system or to save some people's friends? And we still don't know really the answer to that. But certainly what happened raised questions about governance. A report came out just about 10 days ago we have something called GAO, Government Accounting Agency, that independent agency that oversees government agencies and does account. And its report said basically the Fed is rife with conflicts of interest. The people giving out the money report to people getting the money. The board, and they're not chosen by taxpayers, they're not chosen by Congress, they're chosen, the people choosing the head of the New York Federal Reserve, Mike Geithner, were chosen by the head of the AIG, the head of JP Morgan, the head of Chase, of the banks that got bailed out. And the conflicts of interest were obvious, and it makes the United States look like a banana republic. So there is legislation that is probably, a committee now is being formed of experts, in which I'm on, to try to look at reform of the governance of the Fed. Something's wrong, and obviously it has to change. I should say it has to change. But the fact that it has to change doesn't mean that it will change, because the bankers like it the way it is, and it's done well by them. And so this reflects why there's such sentiment, such support for Occupy Wall Street. Relatively few people, but polls show that it has the support of about 2/3 of Americans. So that they are reflecting a view that is widespread. Something has gone wrong with our democracy.
I'd now like to invite the Vice Chancellor to say a few words.
It's getting late, so I don't want to make a big speech, except I wish to convey Professor Stiglitz that on my own behalf and on behalf of the university, how happy we are that you acceded to the request of Dr. Deepak Nair and agreed to give a lecture at JNU. We thank you very much for your visit here. And I am sure that this is not the last time. You see the enthusiasm of many of the students. There are many more questions they would have liked to ask. So I would request Professor Nair that keep in touch with him and see that we can get him again at JNU, probably that time in a bigger hall where students don't have to stand and we can listen to you more comfortably. The other thing I was, while listening to you, I also was thinking, if I had listened to a teacher like you, an expert like you in my earlier career, I would have chosen economics rather than biology in my subject. I'm only worried that my biology students, I'm not in biology, they might now be tempted to move into economics. But I should tell them they should stick to where they are, because economics is now invading even biology, and we have a new field of bioeconomics coming up in a big way. So I think this is something which we'd also like to start in JNU. I thank you very much for coming here and look forward to another visit to you in this university. Thank you very much.
A last word for Professor Arun Kumar, Chairman of the Economics Department.
But it's my pleasant duty to